Most investors are asking, is there still any value left after this current surge we've seen over the last few months? It seems we're seeing a little bit of profit take at the moment.
Yeah, look, that's a really interesting and I think fairly challenging question at the moment, Mark. And I think to a degree what's happened is that in the period since the GFC, I think we've become accustomed to generally pretty favourable valuations across the board. And that's been the case for quite a number of years now. And in the most recent 6 to 12 months, we've seen the market rally pretty strongly. We haven't seen earnings rise at anything like that rate, and the valuations have become much less favourable as a result. And one thing that's clear is that the valuations we see now are certainly the worst valuations that we've seen since the GFC. At the same time, I think that post-GFC period has been unusually favourable in terms of valuations generally. And if you expand your sort of horizon and look at the sort of valuations that we saw prior to the GFC, what you see is that valuations could potentially run some way from here. So I think it's an interesting and challenging question in that valuations look pretty stretched on one measure, but on a broader measure they look as though they've got some way to run. As to the short term, it's anyone's guess, and we certainly don't feel as though we can confidently predict what will happen in the short term. But I will note that we've seen some pretty big moves day to day in the last few days, and historically when you see volatility like that, it's a pretty good indicator that you're going to see an elevated level of volatility going forward. But that's something that we watch with interest rather than something that we think should govern investment decisions.
All right, let's go to our first caller, and it is Frank from Brisbane. Frank, you're there.
Yeah, thank you for taking my call.
You're welcome.
I just wanted to speak or ask about M2 Telecommunications.
I think it's a sector where you can often find synergy benefits through consolidation. And I think M2 is certainly one that's interested us. We own it in the Montgomery Fund, and so we've been looking pretty closely at the announcement and what that means. And we've done an assessment of what it does for the value of MTU, and we think it is somewhat accretive to value. There is a bit of an issue in that it's largely debt funded, and the debt level in MTU will rise from about 1 times EBITDA to perhaps 1.7, 1.8 times EBITDA, and that's a bit higher than we would like, but on a pure valuation perspective, it looks as though this is not a bad acquisition. And the other thing that maybe we're reading too much into it, but the Primus acquisition presumably is going pretty well, I think, or the board wouldn't be coming out so quickly and announcing 2 acquisitions like this. So I think MTU is probably reasonable value, and its valuation has potentially improved somewhat. There's the integration issues, which can be very challenging, as Jeremy's pointed out. But assuming they can be executed reasonably well, and MTU has a track record, albeit on small acquisitions, but a track record of executing pretty well. And my sense is that Primus, their last big one, is being integrated reasonably well. And so we're broadly positive on this development and positive on the stock.
Maybe positive, Tim, but Frank wants a number. Give us a number. What's a number? What's a good number where you rethink your strategy or rethink the stock?
Rethink the stock? Look, I think north of $5.50 we'd start to rethink the strategy on this one.
Okay, there you go, Frank. $5.50 should be a reasonable call. Okay, our next caller is Ken from Brisbane. Ken, are you there?
Yes, thanks, Mark. Just wanted to ask the panel of what they thought about Codan CDA.
Codan is an interesting situation. The main business for Codan is gold detectors. They make the best gold detectors in the world. You pay $5,000–6,000 for a Codan machine. The best competing machine sets you back about $1,500. The reason they command that sort of price premium is that they're much better. They don't detect a whole lot of random metals. If you're a gold prospector, you buy a Codan machine because when it beeps, there's gold there. And what has happened with Codan recently is there's basically been a big gold rush in the Sudan and more recently in other parts of Africa. And there's been some huge nuggets found, and there's a lot of excitement. It is a traditional gold rush, and what that means in this day and age is that people want to buy the very best gold detector they can.
Yeah.
And there are people are setting up businesses where they'll hire a team of people, they'll buy 10 of these machines, and people will work in shifts using the machines to find gold, and the economics work, particularly with the gold price where it is. The challenge is understanding whether the Codan P&L will stay at the current level. So profit has surged from around 30 to around $56 million in 2013. In order to believe that Codan is good value, you need to believe that that level of earnings is sustainable. And there are some arguments to think that it is sustainable and that they've developed a lot of new markets and there are new territories where potentially gold might be found. But I feel that part of that surge is the gold price is high and there's been a gold rush, and it's really quite hard to know what the future earnings might be. On that basis, we're lightening, and in fact we're almost out of Codan is probably the most concise answer that I can give.
Our next caller is Mark from Butterham. Mark, are you there?
Yes, I am. Thanks very much for taking my call, gentlemen.
You're welcome.
Got two stocks, Woolworths and Leighton's. Woolies, I got in at about $28. I'm just wondering, because it's hit an all-time high, is it worthwhile keeping or so forth? And Leighton, I'm down about $1. I'm just wondering, is it worth hanging on to and seeing where we go?
On the competition with Coles front, I think people see that Coles has been growing its sales, improving its margins. The thing that you need to remember is that Coles, prior to its acquisition by Wesfarmers, was really badly managed. So it's catching up. It hasn't. I don't think it's gone past Woolworths. It's really it's been catching up. And Woolworths, when you step back from it, I absolutely agree with the point. It's a great business and it's one that you can own for a long period of time. It consistently earns a very strong return on equity. It has the ability to deploy quite a bit of incremental capital year after year, grow its asset base and grow its earnings. And depending on what style of investor you are, I think if you're a long-term value investor, Woolworths is the sort of stock that you never sell. You just keep it. There'll be times when it doesn't do that well, but in the long run, it's going to grow its value. And why sell it and pay tax on the gain when it's going to be when it's going to continue to do well? So I absolutely agree with the conclusion that you avoid selling that one. And on Leighton, I also share Jeremy's view. It's a business where there's really no transparency. You can't see what's going on inside Leighton, and there are risks that can come out of nowhere and wipe out large chunks of the value.
I think that chart there, illustrates that type of cyclical nature or those things jumping out of the woodwork that you're talking about.
Yeah, and we saw a range of surprises with losses on big contracts a couple of years ago. And with Leighton, you just cannot see when those things are coming and when the risks are high and when the risks are low. So I agree with the view that it's not one that you want to own long term. And it doesn't look like particularly good value to me either at the moment. So big fan of Woolworths, more sceptical of Leighton.
It's time to crank up the stock watch yet again. This time Tim is going to give us his opinions. Tim, what are you watching? Your time starts now.
I'm watching Silver Chef, which provides rental equipment to cafes and restaurants, and more recently has expanded its equipment rental business to include other sectors as well. Since 2005, Silver Chef has grown its earnings per share at a compound rate of over 20% per annum, which is extremely good, and we think it's got some way yet to run. The share price has caught up with intrinsic value, but if the earnings continue to grow, the value will grow and the share price can continue to go up.
Tim's stock watch before the break was Silver Chef. And we'll just get that chart up. And Tim, would you like to tell us a little bit more about Silver Chef?
Sure. Silver Chef started out some decades ago as what they did was they made pizza ovens. And a big high-end pizza oven is an expensive bit of gear. It's something like $20,000, $30,000. And what they found was that in order to allow their customers to afford them, they needed to come up with some sort of financing arrangement, and they came up with this rental financing model, which worked extremely well. And over time, the business has evolved so that they no longer make pizza ovens; they just rent equipment. Primarily to cafes and restaurants, so your fridge, your stove, your coffee machine. Silver Chef put together packages and just make it easy for the cafes and restaurant owners to be able to operate that, have access to that equipment. In 2009, they established a business called Go-Getter, which does the same thing but for a range of other businesses. And the growth of that business has been really spectacular. They seem to very much know what they are doing. And as I mentioned before the break, the earnings per share growth rate has been very, very strong. The business is still not that large. It's capped at under $200 million, and we think there's quite a bit of room for it to continue to grow. So while the share price has caught up with intrinsic value, and it's not a screaming buy as it was last year, we think it's still a business that's well worth investigating, and potentially one that will be worth quite a bit more in years ahead.